Candlestick charts provide very useful trading signals and most effective in predicting market direction. In this video, you will learn the most important essential candlestick patterns which you must know in order to make profit in any market. It is also important that you use candlestick chart combined with technical indicators. Candlestick charts can be used for any market in any time frame. A candlestick's chart is made of bars. Each bar represents a candlestick which shows open price, high, low and closed prices for the set time frame. You can set up a chart as intraday, daily, weekly or monthly, based on your trading strategy. Each candle may represent 1 minute, 5 minutes, 1 hour or 1 day depending upon the period of price action you like to see. Let's look at anatomy of each candle. When you look at most stock charts in any website, candle colors will be green or red. People also use black or white color for candlesticks. White is same as green and black equal to red. Only green or red color candles will be used in this video. The long thin lines above and below the body are called shadows. Shadows represent the highest and lowest price range at that time frame you set up for a candlestick. Also called wicks or tails. Shadows may be long or short depending upon price volatility and how far the prices move up or down before close. The bottom end of the lower shadow is the lowest price traded during the time frame of the candle. The top end of the upper shadow is the highest price traded during the period of a candlestick. Range is the difference between the highest and the lowest prices of the candlestick. Open. The open is the first traded price beginning of the candlestick's time period. Close. This is the last traded price of the candlestick. The close price determines the color of the candle. The body is the range between the open price and close price. If last traded price, close price is higher than open price, the candle is green. If the last trade closes below the open, the candlestick will be red. The green candle is bullish and the red candle is bearish. Size and shape of the candlestick can tell you how market is acting. A long body with no or very small shadows indicates that there is heavy trading into one-way direction. A green long candle means buyers are in control. A long red candle means that the trading session was controlled by sellers. The longer the candle, the stronger the force is. A candlestick with no shadow is called marubozu, which indicates that there is a strong movement to only one direction. Sometimes you might see a long green candle suddenly changes into a long red candle or a long red candle changes to a long green candle. It means that very big seller or buyer moved the price or major events such as earning or company or the market's news, either good or bad, changed the price action. A candlestick with a small body means there is a very small difference between open and close prices for that time frame. Bulls and bears have almost same forces. Buyers and sellers are balanced out so the price would not move either way. After a long uptrend or downtrend, a smaller body and longer shadows candle indicates that price momentum gets decelerated and the current price trend is getting weak. The trend reversal is coming ahead. You need to look at other technical data such as resistance or support levels, volume increase or decrease, MACD and RSI indicator. In my future videos, I will explain how to view and trade with MACD, RSI and resistance or support levels. If a candlestick has a long upper shadow and long lower shadow with small body at the center, it is called a spinning top. Color of the body is not important. This pattern shows the sellers and the buyers have balanced force. The buyers took the price up and the sellers took the prices down farther from the open, but neither of them couldn't hold the price up or down. So the price came back to near open. The close and the open price are not much different. That created a small body. Spinning top is an indecision between bulls and bears. The current trend is losing momentum and market will be changing direction or range-bound movement can be expected. Trade decisions should not be made based on a single candlestick. You need to wait for confirmation by looking for the subsequent candles which can confirm trend changes. Also remember to check resistance or support levels. The reversal pattern can be expected after a very long uptrend or downtrend. Trends become exhausted and price direction will start change. Whoever controlling the market, buyers or sellers getting weak and the spinning top hints that changes are coming. If you are holding stocks or crypto in the uptrend, you might want to put stop-loss order to protect your profit. If you are waiting to enter the market, you might want to start buying after subsequent candles confirm trend changes. Also remember to look for other indicators too. Here are two most powerful candlestick patterns: hammer and hanging man. Candlesticks have long lower shadows and small bodies with little or no upper shadow are called hammer or hanging man, depend on where they occur. The lower shadow is long, at least double the length of the body. Close and open prices are at the top of the candle. These candles occur because the price went down further from open and then back up to near open price. These two have the same shape. The difference between them is hanging man is a bearish candle. It may be green or red color, which appears at the top of an upward trend, hinting that a bearish reversal is coming. Hammer is a bullish candle, may be red or green color, appears at a downtrend, showing that the bottom of the downtrend is reached and a bullish reversal is coming. The patterns are easy to identify. Hammer shows that sellers are able to bring down the price after the open and then ran out steam at such low prices, and buyers entered at a low price level, so the downtrend could not be continued any longer. Strong buying force pushes the price up in the later part of period, and the stock closed near or mostly above the open price. The long lower shadow occurs when the price fell from open to a support level, then bounced upward and get back near the open price. The body can be green or red, but a green candle is considered to be a more bullish indication and make a stronger sign. The close price can be a little lower or higher than the open price. However, you should wait for a few subsequent green candles for confirmation of bullish trend reversal. If a hammer appears after a long downtrend at support level and with increased volume, buy signal is stronger. Inverted hammer is a candlestick that is similar to hammer pattern but is inverted. Just like hammer, if this pattern appears at the bottom of a downtrend or during a downtrend, it is a sign of a potential bullish reversal. The inverted hammer occurs when buyers pull up the price and the price reached far above the open price during the period. Then the price came down and got back to lower end and finally closes near or below the open price. The candle's color may be green or red. Inverted hammer shows that bulls tried to bring up the price, but sellers gave resistance to buyers and the candlestick ended up close near where it began. Even though bulls could not succeed to bring up price in this period, there is a high chance of buyers winning later on. The market may soon be rally. Inverted hammer is one of the good indicators to look for bullish reversal direction. Shooting star, another candlestick which looks like an inverted hammer, is shooting star. The shape of a shooting star candle is the same as an inverted hammer, but the shooting star appears at the top of the uptrend while the inverted hammer forms in a downtrend. The shooting star is a very reliable bearish pattern when it appears at resistance level after long uptrend. Bulls are getting weak. Buyers took the price high from open price, reached the top of the uptrend resistance level. But sellers came in at resistance level and brought the price down. The price opens gap up, climbs much higher and then reverses. It closed near the open or lower. The candle may be green or red. Let's summarize this video. Bullish candlesticks are hammer and inverted hammer. Bearish candlesticks are hanging man and shooting star. Indecisive pattern is spinning top. This video is part 1 of candlestick charts. In my next video, part 2, you can view other powerful candlestick patterns such as doji and trend reversal bullish and bearish engulfing patterns. Please subscribe my channel for future videos.